There is a severe divergence happening in the market right now, and if you are completely focused on chasing the next high beta altcoin narrative, you are walking directly into a liquidity trap. Right at this moment, the smart money is quietly orchestrating one of the most aggressive capital rotations we have seen since the 2022 lows. Let me give you one piece of data to anchor this entire conversation. Binance Ethereum reserves have just plummeted below their February 2024 lows, draining down to roughly 3.3 million Ethereum. Meanwhile, stablecoin purchasing power is exploding on that exact same exchange, with 38 billion in Tether and 6.7 billion in USDC sitting idle on the sidelines. This is the textbook definition of a supply shock. Less available asset supply, combined with record levels of dry powder, creates an asymmetrical setup where the price has nowhere to go but up. But retail investors are completely missing it because they are distracted by decentralized finance hacks and short-term volatility. In this video, we are not guessing. We are going to rip through the hard on-chain data, the shifting macroeconomic environment, and the exact daily chart structures for both Bitcoin and Ethereum. I'm going to show you exactly where the institutional invalidation levels are, why the base layer assets are decoupling, and how to position your portfolio for maximum risk-adjusted returns without stepping in front of a freight train. Before we look at a single chart, we have to understand the macroeconomic gravity that controls every single tick in these markets. You simply cannot trade digital assets in a vacuum. Right now, the global liquidity landscape is quietly pivoting, and it is setting a massive trap for bears who think the tightening cycle is going to last forever. Let's talk about inflation. The mainstream financial media has been victory lapping a soft landing for months, but the leading indicators are violently rejecting that narrative. When crude oil spikes, global food prices almost always follow. If you overlay Brent crude against the Food and Agriculture Organization Food Index, the correlation is undeniable. We are staring down the barrel of a secondary wave of structural inflation driven by geopolitical supply chain shocks. And this changes the entire game for the Federal Reserve. A resurgence of inflation destroys their forward guidance. But here's the piece of data that's not being talked about enough. The Federal Reserve's balance sheet has actually begun to grow again. It's a slow bleed right now, expanding by roughly $30 to $40 billion per month, but it's happening. Furthermore, escalating geopolitical friction, particularly the risk of kinetic conflict involving Iran, will almost certainly force the Fed to accelerate their treasury purchases to stabilize the bond market. Speaking of Iran, the geopolitical chessboard is radically altering the utility of digital assets. Iran is currently testing an alternative financial system right at the Strait of Hormuz, a maritime choke point that handles 20% of global oil flows. They are actively accepting yuan and crypto to bypass United States sanctions. This proves that crypto has fundamentally graduated to a macro geopolitical settlement layer. It's no longer just a speculative beta play on tech stocks. However, this undeniable utility comes with a sharp, double-edged sword. As nation-states utilize non-dollar assets to bypass sanctions, it significantly raises the risk of aggressive regulatory blowback from the United States government as they attempt to protect dollar hegemony. This macro storm of expanding liquidity and geopolitical friction is the exact environment where hard money digital assets historically thrive. Now let's map this macro environment directly to the on-chain data, because the fundamental valuation metrics are screaming that a cycle floor is firmly in place. First, look at the Bitcoin to gold ratio. Bitcoin is the digital successor to gold as a non-sovereign store of value. And right now, the ratio charting Bitcoin's value against gold on the weekly time frame has hit extreme negative standard deviation levels. The ratio has never deviated this far from the historical power law. Simply put, Bitcoin is currently massively undervalued relative to the legacy safe haven asset. Sophisticated valuation models suggest an aggressive mean reversion is imminent, meaning Bitcoin is mathematically primed to drastically outperform gold in the near term. This undervaluation is heavily corroborated by the capitulation data. Right now, approximately 8.2 million Bitcoin are sitting in a state of unrealized loss. When we look back at historical market structure, This specific supply in loss metric has hit these extreme thresholds only a handful of times, and they perfectly align with absolute cycle bottoms. The weak hands have folded. The retail capitulation is largely complete, and because the vast majority of the selling pressure has already been absorbed by the market, the downside risk is incredibly limited from a probability standpoint. We can see this capital absorption directly on the exchanges. The Bitcoin balance on centralized exchanges just hit its lowest level since 2018. Only 14.6% of the total Bitcoin supply is left on exchanges to be traded. This is a multi-year macro trend of supply being permanently drained from liquid markets and locked away into institutional custody and cold storage. Think about the mechanics of this. We have liquid supply exhaustion colliding directly with an expanding Federal Reserve balance sheet. When new fiat liquidity floods the system and there simply is not enough accessible Bitcoin to satisfy the demand, the order books thin out, and you get violent upward price re-ratings. And it's not just one metric telling us this. We have total confluence across 6 independent macro oscillators. The market value to realized value ratio, the long-term holder spent output profit ratio, net unrealized profit and loss, the Puel multiple, perpetual open interest, and the aggregated funding rates are all simultaneously sitting in the deep value zone. This is the exact mathematical zone that has marked every generational cycle floor in the asset's history. When data over emotion dictates your strategy, a convergence of 6 independent oscillators is a signal you simply cannot ignore. While Bitcoin acts as the pristine collateral, the structural growth occurring on the Ethereum network is what should truly capture your attention as an investor seeking yield and capital growth. The institutional milestones being hit right now are staggering. Coinbase recently received conditional charter approval from the Office of the Comptroller of the Currency. They are no longer just a crypto exchange. They are operating as a federally regulated trust company. This completely dismantles the final compliance hurdle for risk-averse, traditional finance fiduciaries. Trillions of dollars in legacy wealth now have a federally blessed, fully regulated bridge to custody digital assets. Pair that with polymarket prediction data pricing in a 65% probability that the Trump Clarity Act is signed into law by 2026, and the regulatory clouds are rapidly clearing. But the real alpha is happening directly on the Ethereum base layer. A brand new consortium called the X402 Foundation just launched under the Linux Foundation. This is an open standard designed specifically for executing payments over HTTP, and it is backed by absolute titans including Coinbase, Stripe, Google, and Visa. They are standardizing crypto rails directly into the foundational protocols of the internet. Soon, autonomous agents, application programming interfaces, and daily web applications will move capital as easily as they move data. This totally removes the friction of Web3 wallets for the average consumer. You can already see this product-market fit showing up in the settlement data. Stablecoin volume has aggressively scaled to $7 trillion, putting it in direct competition with legacy financial systems like Visa and automated clearinghouses. Programmable money is swallowing the global remittance market, and Ethereum is the primary settlement layer for this activity. In the first quarter of 2026, the Ethereum network smashed a record 200 million.4 transactions. That is its highest quarterly volume ever recorded. The network is fundamentally decoupling from speculative price action. Despite all the macro uncertainty and risk-off sentiment in the traditional markets, Ethereum is printing 788,000 daily active addresses, with roughly 255,000 brand new addresses being created every single day. A massive driver of this Blockspace demand is the intersection of artificial intelligence and decentralized infrastructure. AI adoption within the Ethereum ecosystem is growing exponentially, with roughly 90,000 total registrations climbing steadily since late January, when that number was near zero. AI agents require autonomous wallets and uncensorable money to function. They cannot open traditional bank accounts. This transition from a speculative tech narrative into verifiable on-chain metrics is driving sustained utility. And the heavy hitters know this. The smart money divergence is glaringly obvious right now. The on-chain balance of whale wallets holding between 10,000 and 100,000 Ethereum is increasing explosively. Small retail investors are getting chopped up in the volatility and losing their balances directly to these mega institutions and Tier 1 funds. The smart money is utilizing this exact moment of fear to accumulate ahead of the supply squeeze. However, as capital allocators, we have to acknowledge the risks. DeFi is currently presenting a massive headwind. The Drift protocol recently suffered a highly suspicious exploit, resulting in over $270 million in assets being drained. Hacks like this completely destroy the trust required to onboard new retail and institutional capital into DeFi yield farms. What makes this specific exploit even more concerning is the infrastructure response. Following the hack, over 230 million USDC was bridged via the cross-cross transfer protocol from Solana directly to Ethereum. It took Circle, the centralized issuer behind USDC, a full 6 hours to freeze those stolen funds. This exposes a critical vulnerability. If centralized issuers cannot act swiftly to protect the ecosystem during a highly publicized multi-hour exploit, it raises severe systemic risk concerns for any liquidity pool reliant on centralized stablecoins. This is exactly why we are seeing a massive flight to quality. Capital is permanently quarantining itself in base layer assets like Bitcoin and Ethereum, completely abandoning the high-risk yield plays in secondary governance tokens. So how do we trade this? Let's look at the daily charts to define our exact parameters. Bitcoin is currently updating its structure with a massive daily falling wedge. This is a classic volatility contraction pattern that typically acts as a bullish reversal signal. The price is currently hovering right around $67,000. Because of the nature of this wedge, we have to be prepared for a potential final dropdown to the $60,000 support level. That kind of flush would perfectly liquidate the late retail longs and clear the board. Conversely, if we break upward, our primary liquidity target is the fair value gap sitting above us between 79 and 82,000. We remain patient here and let the structure resolve. Ethereum, however, is telling a completely different story. Unlike Bitcoin, which is still trapped inside its consolidation, Ethereum is displaying immense relative strength. It has already broken to the upside of its own falling wedge pattern and is currently executing a textbook retest of that breakout. Right now, Ethereum is resting directly on the point of control at roughly $2,030. For those unfamiliar with volume profiles, the point of control represents the price level with the heaviest traded volume. It's the absolute baseline of institutional interest. But the real alpha on this chart is what sits immediately above it. There's a massive low-volume node spanning from 2,450 up to 2,650. In institutional trading environments, a low-volume node acts as a fair value gap. Because so little historical trading occurred in that zone, there's no structural resistance to slow the price down. If the bulls can successfully defend this $2,030 point of control and confirm the wedge retest, the price action will not be a slow, choppy grind. It'll vacuum aggressively and violently toward that green box to fill the inefficiency void. Your invalidation level is crystal clear. If the $1,950 level breaks and closes lower, the structural floor falls out, and our next immediate downside target is the $1,800 level. The data is pointing to a highly aggressive bullish setup for base layer assets, while simultaneously signaling a strict risk-off environment for decentralized finance. The macroeconomic stage is set with a quietly expanding Federal Reserve balance sheet and the looming threat of secondary inflation. Meanwhile, absolute supply exhaustion is flashing across the Bitcoin and Ethereum networks, corroborated by deeply oversold on-chain oscillators and aggressive whale accumulation. The institutional demand is here, the regulatory walls are falling, but the smart money is avoiding the yield farms and aggressively bidding the base layers. As an investor, your job isn't to predict the future. It's to align your capital with the highest mathematical probabilities while strictly defining your downside risk. The charts have given us clear invalidation levels, and the fundamental data has given us our macro direction. Let the data dictate your execution. Keep your emotions entirely out of the order book, and always prioritize capital preservation. If this deep dive analysis brought you value today, hit the like button and subscribe to the channel so you never miss our data-driven updates. For those of you who treat the markets with absolute precision and want to look over my shoulder as I navigate this exact rotation, I want to invite you into the Pro Capital Vault. This is my private community hosted on Discord, accessible exclusively through the YouTube members program on this channel. I share my exact real-time portfolio tracking and map out the precise buy and sell zones I'm executing in my own accounts. If you are a serious position trader or investor looking to step away from the noise and focus on pure, data-driven execution, click the Join button right below this video, scan the QR code, or use the link pinned in the top comment to step into the vault. Once you join through YouTube, just sync your account directly to Discord to automatically unlock all the private channels. To continue building your macro framework, I highly recommend watching my recent breakdown on Chainlink, as their Oracle infrastructure stands to benefit massively from the exact institutional utility metrics we covered today. You can click the video on your screen right now to watch that next. As always, remember that this analysis represents my own market research and structural frameworks, and should never be interpreted as financial advice. Much love for watching, manage your risk, and I'll see you soon in the next deep analysis.